Should you Netflix and chill, make it a movie night with Max, or pick a new show on Paramount Plus? Can't decide? These days, there are more streaming services than ever, and customers have only so much time and money they're willing to spend on each.
Consumers have challenges right now dealing with a very large number of services, discovering content. The user experience can be a little clunky when you compare it to pay TV, where you could just change channels rather than going in and out of apps. And is expensive if you try and replicate what you had with cable and you have to sign up for a number of different services.
And in this very competitive industry and crowded market, can these individual services continue to compete, or will they have to merge to survive? John Harrison is a media and entertainment analyst at Ernst & Young.
I do believe that consolidation helps rationalize the complex industry, both for the operators and the consumers. So until the industry turns a corner to profitability and sustainable free cash flow generation out of the streaming business, it's going to be rough waters.
Unless you're Netflix, says IBD reporter Patrick Seitz. On November 1st, the streaming company reported 15 million worldwide subscribers for just its advertising-supported service, only 1 year after its launch. It ended its third quarter with a total of more than 247 million subscribers worldwide.
Netflix is the only one of the major streaming services that's making money. A lot of the Hollywood studios and content providers have gotten into the business because they've seen how successful Netflix has been, but they're losing billions trying to catch up to Netflix.
Take Disney. The entertainment giant announced last week it would acquire the remaining 33% stake in Hulu from Comcast-owned NBC Universal for more than $8.6 billion.
The problem Disney has is that they've got great content, but these shows are very expensive to produce. I mean, they're special effects heavy, they've got big stars, and so these Marvel properties and Star Wars properties, that's what they're known for.
For the 2023 fiscal fourth quarter, Disney Plus reported about 150 million global subscribers. That's up from the approximately 146 million subscribers the streamer reported in the fiscal third quarter. Still, the House of Mouse has upped prices for Disney Plus, Hulu, and ESPN Plus twice this year. In fact, the cost of ad-free major streaming services is going up an average of 25% this year, according to the Wall Street Journal. Netflix raised its ad-free premium plan by 15% to $22.99 a month in October. Disney Plus went up by 27% to $13.99 per month, and Apple TV Plus is now $9.99 a month, up 43%. Additionally, Disney Plus may be joining the likes of Netflix to crack down on password sharing. For years, streamers kept prices low in exchange for fast growth, but now they're making the move toward profitability and hoping raising rates, adding commercials, or cutting content doesn't result in subscribers canceling services, otherwise known as churn.
The question is, how many people really want to watch advertising after they've learned over the years that it's a great experience to not have ads to interrupt their programming.
Over the summer, Americans spent nearly 40% of their viewing time streaming, compared to television viewing, which for the first time fell below 50%, according to Nielsen. Traditional TV monetized 57 cents per hour viewed last year, according to analysis from research group MoffettNathanson. Streamers can only bring in 27 to 42 cents an hour. And even with the continued push to streaming and more consumers cutting the cord on cable, the revenue, at least for now, pales in comparison to the legacy linear model. The LA Times reported,
The media companies are trying to balance out how they can extract as much of the remaining value and really cash flow opportunity from linear while they ramp their streaming businesses.
Let's talk merging live sports with streaming platforms. Is that a move that can really jumpstart growth for these companies?
Yeah, live sports, has always been described as the glue that holds the pay TV bundle together, especially for sports fans. And the viewing experience is so proven out on broadcast. And so the streamers are absolutely catching up.
Max began offering live sports like Major League playoff games and regular season NBA and NHL matches in October. The platform may be hoping live sports bring in more subscribers. With about 96 million, Max falls behind Netflix and Disney. But live sports doesn't come cheap, and Max's price is going up. Now Warner Bros. Max, including sports, costs $10 monthly for ad-supported plans and $16 monthly for its ad-free tier. But come February, Discovery will raise these prices by $10 a month for live sports. That's just in time for college basketball, March Madness, and the NHL playoffs. Other streamers like Paramount Plus, Peacock, and Amazon Prime are offering sports at no extra charge. Peacock will stream one wildcard NFL playoff game early next year that will not be available on cable or broadcast network. And Amazon includes Thursday Night Football free with Prime Video. Will live sports score big for streamers? That's yet to be seen. And will there be more big mergers for streaming platforms? Paramount added Showtime to the premium tier of Paramount Plus in June, but Harrison says beyond that is not in the playbooks for these companies.
With values down and capital markets choppy, it's expensive to do a gigantic merger like that. There's regulatory hurdles. So then the question becomes, is there a path to get the consolidation?
No one wants to admit defeat. And so no one's just going to stop their service and bail out. They definitely want to merge.
For Investors Business Daily, I'm Meredith Heyman.